All right, so we have gone through the entire accounting cycle now in the first 3 chapters. And I don't know if I used the term accounting cycle before, but I'm using it now because this is the process financial accountants use. Okay, there's other types of accountants, managerial accountants, which we'll learn all about in the next semester. But financial accountants are the ones who deal with the transactions and take from transactions into a reporting on the financial statements. Okay, so we're going to kind of summarize the accounting cycle in this chapter and talk about what are called closing entries, where we prepare to get ready for the next financial period. Okay, so that's where we're at now. So if you think about what we did, we started with transactions and we journalized those transactions. We recorded the debits and credits happening each time a transaction occurred. And then we kept a ledger. We took the transactional data from the journal and put it into a ledger so we could have balances for each of those accounts. And at the end of the financial period, we took all those balances and summarized them in a trial balance. Then we looked for any adjustments we might have to do. And remember, those adjustments always arose because either we earned expenses and hadn't yet been paid for them, or incurred expenses, or earned revenue and hadn't yet been paid, or the opposite, where we had incurred expenses, or we had paid earlier for expenses but hadn't yet recognized them as expenses. And so at the end of the month, we say, okay, we've had this month as prepaid insurance, or we received cash for revenue in advance but hadn't earned the revenue. So now we have to record it. So those are the adjusting entries. After we did those, then we did an adjusted trial balance. So once we do an adjusted trial balance, we're ready to create our financial statements. The financial statements are just a summary of the data from the adjusted trial balance put into a format that's standardized so that anybody with a little bit of business education could look at these statements and have an idea of what's going on in the business. That's the intent, okay? So I work as a treasurer for some nonprofit organizations, not work for, I volunteer, okay, like AYSO Soccer. I'm the treasurer for that and have been for years. And so what I do is I prepare a statement so at our board meetings, all the members who are on the board can understand the financial position of the organization, right? So they know how much money we have, so we can make decisions about what things we want to spend, what our pricing is going to be for the next year, and so forth. Those are the things we do. So the first statement, you've already seen this, so it's not new to you, is an income statement. And so the income statement summarizes revenues and expenses. Another way would be to say, well, how much money did we make for this period? Now, remember, it could be tricky when someone says, how much money did we make? Because this isn't necessarily all been received in cash, right? And we haven't necessarily paid all these expenses in cash. There might be liabilities payable, meaning we haven't paid them in cash yet, or revenues receivable sitting out there. But this is what we've earned and the expenses we've incurred. So for this book, what they say is, so that means in your homework sets, they like us to list these expenses from largest expenses to smallest expenses. I will tell you, in real world settings, not everybody wants it done that way, okay? Some like to, you remember they've showed you in some of these problems that they have account numbers for each one. Some like them to be in like an account number order. Others don't care, okay? I think maybe this order that this textbook wants us to use is good in the sense that you can see the biggest expenses quickest, easiest, they're on top. So I don't think that's a bad way of doing it. So we can see this company, Net Solutions, who's been our example all the way through these first 3 chapters. They earned $16,840 in fees. They also earned $120 in rent revenue, so their total revenue was $16,960. Then they had wages, supplies, rent, utilities, insurance, depreciation, and miscellaneous expenses. So they had total expenses of $9,855. So their net income was $7,105 for this period. So here's my question for you. What is this period? Is it a year? Is it a month? What is it? Yeah, so they're a little weird, right? Their income statement is for the 2 months ended December 31st of the weird year thing they do, right? So you have to sometimes look up at the top and make sure you understand what period of time we're talking about. Was it a month? Was it a quarter? Was it a 2-month period? Because it could be really, you could really make some wrong interpretations if you think this is just a month, but it was 2 months, or if you think it was a whole year, but it was just 2 months, right? So you have to be careful. If you haven't noticed yet, accounting is a game of attention to detail, recognizing little small details of things, and that can be challenging at times. Let's see, clicker, why aren't you working? All right, so the second one, the statement of stockholders' equity. Remember, this company, Net Solutions, was a brand new company. So in the beginning, they had no common stock, no retained earnings, no nothing. Then the owner issued common stock, which means the owner put money into the business, and the business issued stock to the owner in return to show that investment. The common stock increased. Then their net income, which again, revenue minus expenses, added to the retained earnings. Then the dividends, money paid back out to the owners, subtracted from retained earnings. And in the end, the business now has a stockholders' equity of $25,000 from common stock, $31,005 from retained earnings, or a total of $28,105. The second major statement, right? And the third is the balance sheet. Recognize that this number, net income, doesn't come off your trial balance. It comes off of your income statement, which you created first. There's a reason you have to create it first, okay? Because you need the net income to figure out the retained earnings. And then the common stock and retained earnings you need for the balance sheet. So they flow from one to the next, okay? So here's something new that we haven't really talked about. It's pretty normal for balance sheets to separate out our assets into 2 categories of assets. The first called current assets, the second called property, plant, and equipment. Sometimes you'll see them called something like long-term assets or something like that, but it's the same idea, okay? So current assets are assets that are cash or readily convertible to cash, or things that we expect to consume or use up within the next year. Okay, that's that 1-year rule, okay? So it's going to include cash, accounts receivable, right? That, when we say use up, what we really mean there is collect it and convert it to cash, right? Supplies, those are things we expect to use up. And then prepaid insurance, another asset we expect to use up. By what? How? By having insurance, right? So that's our total current assets. And then we have our property, plant, equipment, which includes land, equipment, and that's it for these guys, okay? Every property, plant, and equipment account, with the exception of land, will have a joined contra account called accumulated depreciation for that account, okay? So that's just how we keep track of how much of this we have recorded as an expense over time. Okay. So the total of current assets and the total of property, plant, and equipment will be the total assets. Liabilities are also broken into 2 categories. Current liabilities, those are debts that we expect to pay off within the next year. And long-term liabilities, liabilities that will take longer than a year to pay off. This business, as of right now, only has current liabilities, and not very many of them, right? And then finally, our common stock. Again, that's the money the owners paid into the business. Retained earnings, the money that the business has earned through net income and hasn't paid out in the form of dividends. So total of our stockholders' equity and our total liabilities would be the bottom line on our balance sheet, $29,495, and it should match the total assets. Why? Because in the very first day we learned assets equal liabilities plus stockholders' equity. Always, okay? Always, like snake, right? Okay, moment of silence. Severed snake. Okay. I just told all of you that was all the stuff on the difference between current assets and current liabilities. So let's just move through that. Okay. So let's get to closing entries. So remember, our whole function as accountants is to record transactions, and then at the end of the period to create these statements. So when we get to the end of that period and we've made our statements, now we have to prepare for the beginning of a new period. And what that requires us to do is to return some accounts back to zero, those accounts which measure change over the time period, and then convert that into a more permanent account. So they actually use the terms temporary accounts and permanent accounts. And by temporary, we mean those accounts, temporary. We mean those accounts that we need to reset to zero each financial period, okay? I'll tell you, it's interesting is that's really going to involve our revenue accounts, our expense accounts, and our dividend accounts. Those are the temporary accounts. Another term you might use for these accounts is income statement accounts, revenue and expense, right? So if we go all the way back to our income statement, let's skip all the way back to it, we're going to see that the time period measured by the income statement is for the 2 months, on this case, ended December 31st, which means the income statement measures balances over time, okay? But the balance sheet's not going to say that. It's going to say as of December 31st. So I want you to think about that. Balance sheet accounts, assets, liabilities, stockholder equity, they are a balance as of a given day. What's the balance of this account? It's whatever the balance is today. Revenue and expense accounts are, well, how much revenue did we make during this period? How much expense did we pay or incur during this period? So the temporary accounts, because they measure something over time, when we get to a new time period, we have to return them back to zero. But the non-temporary accounts, they're going to maintain balances. Okay, so closing is the process that we use to close out these accounts. If you can't remember my explanation I just gave you as to what's different between temporary versus permanent, then at least just remember the accounts you're going to have to close are revenue, expense, and dividend. Okay. So here we have a process whereby we have to close them. So expense accounts at the end of the period are always going to have a debit balance in them. Why? Because that's the normal balance in an expense account. So the way to close the account would be to credit the account the amount of its balance, leaving the new balance as what? Zero, right? That's, kind of obvious. So to close our expense accounts, what we're going to do is we're going to, remember they all have balances on the debit side. We're going to credit those accounts. Now there's something going on here, and is we can't really credit these without debiting some other account. Okay, so what's happening is we're creating a special account just for the closing process that we call the income summary account. Okay, and it's also temporary. It's going to be immediately returned back to zero. So here they show it just as going into this total revenue, total expenses. But if you think about it, what we're doing is creating this special account. We're crediting all of these expense accounts so that we can bring their balance to zero. And if we're doing a credit here, then what do we have to do somewhere else? A debit, right? Like, so we're going to debit $9,855 to this special account. So now we've effectively closed all the expense accounts, but we've opened this new temporary account just for a moment. Okay. Then We're going to look at our revenue accounts. We had two of them, if you remember. One was fees earned, the other was rent revenue. They both had credit balances because credit balance is the normal balance for a revenue account. So to close those, we're going to debit the account. So fees earned will debit $16,840. The new balance of that account will be zero. Closed. Back to zero to start for a new period. Rent revenue, $120. So we will credit, if we're debiting those accounts, we'll credit the income summary account, $16,960. The new balance of the income summary account then will be $7,105. So let me ask you this. Where have we just seen these numbers? Everybody remember? On the income statement. So this represents our total expenses. This represents our total revenue. So this represents our net income. Okay? We would expect that. Now, what happens to net income? What account does it affect? Right. So to close income summary, it has a credit balance of $7,105. We'll debit income summary, $7,105. We'll credit retained earnings, $7,105. We've now moved the temporary accounts of revenue and expenses momentarily to a temporary account called income summary, and from income summary to retained earnings. And now we've closed the temporary accounts. They all have balances of zero. And the only account that still has a balance from that activity is a permanent account. That's what closing means, okay? So we're taking the temporary accounts, revenue and expense, and then dividends, and we're closing them to retained earnings. And by closing, we mean we're taking their balances down to zero and putting them over to retained earnings. Dividends has a debit balance of $4,000. Why? Because that's the normal balance for dividends. So to close dividends, we'll credit it $4,000, and we'll debit retained earnings $4,000. So revenue and expenses close the income summary for a moment. We get the balance, and then we close that balance, which is net income, straight to retained earnings. And then dividends, we just close straight to retained earnings without the income summary. Okay. So retained earnings will get 4,000 here. And the new balance. If you think about it, this is just all the information that was just summarized on the income statement and the statement of stockholders' equity, but the sort of accounting language side of it as opposed to the report side of it. So we do the report so that the layman, right? In my case, the director of our board, who is she has a medical practice with her husband. She's not an accountant. So I put it into these reports so it's easy for her to see the summary, right? But I know that underneath, this is really what's happening, is we're taking all these accounts back to zero so that we can start the new period. Now, on day one of the next time period, revenue is zero. So any revenue we start to earn during that time period will accumulate in my revenue accounts. Any expenses we incur will accumulate in the expense accounts. So this is called the closing process, okay, or just closing entries. Here's a summary of the closing entries. So here, this book is a little different than past books I've used. I think what they're doing is they're just, oh, that's tiny. So there's all of those asset and liability accounts. So after we do those closing entries, we're going to have what's called a post-closing trial balance. And you'll see that that only has assets, liabilities, and stockholders' equity. No revenue or expenses because they all have a balance of zero. They've been closed. So there's your post-closing trial balance. All right. So this is just a rehash of what I started with, the accounting cycle. Step one, transactions are analyzed and recorded in the journal. Step two, they're posted to the ledger. Step three, an unadjusted trial balance is prepared. Step four, adjustment data are assembled and analyzed. Step 5, an optional end of period spreadsheet is prepared. Did one of your homework problems have a spreadsheet? I think I saw someone working on one. No, we'll look at one real quick here. Step 6, adjusting entries are journalized and posted to ledger. Step 7, an adjusted trial balance is prepared. Step 8, financial statements are prepared. Step 9, closing entries are journalized and posted to the ledger. Step 10, a post-closing trial balance is prepared. And it's a cycle, so you're in a new period and you're back to step 1. Okay, that's it. Like, honestly, that's all we're doing here, right? So everything else we do actually after chapter 4 is just like drilling down deeper into each of these. We'll learn more about different types of assets, more about different types of liabilities. But what we've already covered is the accounting cycle, okay? This process we're going through of converting from journal entries to reports and back to 0. So this is another company. I'm just going to walk you through that real quick one more time. Okay, this is Kelly Consulting. So here's their journal entries throughout the period. Looks like the owner contributed some common stock. The cash went up, but they also bought some accounts. Oh, this is the journal. So I don't like that first transaction. It's got too much going on in it. Anyway, so they funded their prepaid rent account with cash. What's going on in this is the owner contributed $30,000. Looks like they contributed like some direct office equipment they didn't do cash, and the company bought office equipment. They just gave office equipment to the company and some supplies, and they gave some accounts receivable. But that's what's a little weird. That usually happens when you buy another company, and so you're buying their receivables. So maybe that's what's happening here. What we're trying to do here is a very basic level of what's called forensic accounting, right? Where we look at the transactions and try to break down what actually happened. They have forensic accountants that work for the FBI, right? And so they will dig back through people's books for the IRS and try to understand what was happening there, so that for criminal stuff and things like that. An interesting job. Anyway, so here's all their transactions, all the journal transactions, and then those lead us to like an adjusted trial balance for this company. And the adjusted trial balance, this is the spreadsheet I was talking about. This is what they said was an optional spreadsheet. Instead of summarizing things on a separate page, like the trial balance and then the adjustments, they summarize it in these columns. So you have all of the accounts listed. You have a debit and credit balance for each one of them, and that's labeled as your unadjusted trial balance. Then your adjustments are listed. Then your adjusted trial balance are listed. So have you guys, was there one of these in the homework? No? Okay. You saying yes, everybody else is saying no, so I'm not sure how to read that. I thought there were. I thought I saw people working on it. Yeah, you helped me with that. In chapter 3, right? So all this is another way of looking at it. Some people prefer to have a trial balance on a separate piece of paper, and then the adjustment data, and then an adjusted trial balance. Others prefer having it all together in a single spreadsheet, where you in essence have these 2 columns for each document. This is the unadjusted trial balance, the adjustments, the adjusted trial balance. Then they do their adjusting entries, everybody's favorite. That leads them to an adjusted trial balance, income statement, statement of stockholders' equity, balance sheet, closing entries. So yeah, we'll have to look at when we get into the homework. So, you know, this whole thing I described with creating this income summary account, it looks like this book does it differently, because when they do their closing entries, they're doing the revenues and the expenses all together. And then I don't see where they're doing the and so then they're just closing the difference to retained earnings. So they're cutting out that step. Maybe it's more efficient actually, cutting out the step of moving it to an income summary. In essence, you debit your revenue account, right? So that it now has a balance of 0. You credit all your expense accounts, so they now have a balance of 0. And then the difference, which is your net income, you're just going to credit directly to retained earnings. So they're not doing that middle step of closing one to this income summary account and closing the others. So we'll have to look at that in the homework. It really does cut a step out that I've always thought was an extraneous step anyway. So maybe this book's going to do a slightly different model. When you switch books, you always have to adjust a little. Just so you know, same thing happens when you switch employers. If you're doing accounting or bookwork, is you'll get used to doing it the way they do it at one place, and you'll move to a new place, and they'll say, "Oh no, we don't call that account that. We call it this," or you know, they want reports every 2 months instead of every quarter or whatever. You just have to adjust. There's our post-closing trial balance, has our assets, liabilities, and stockholders' equity with no revenue or expenses. I think you will find this chapter easier than chapter 3. Most people do. Chapter 3 is kind of a toughie. Just because those adjusting entries, like you're like, do I have to calculate something here? Or are they giving me the number? And it all relies on these little tiny context clues in the language of how it gives you the information, right? Kind of like that one we were looking at the other day. So, all right. So there's 2 analysis ratios they give us for this chapter. One's called working capital, and the other is called the current ratio. And the reason they haven't given us the current ratio yet is because we hadn't differentiated current assets from property, plant, and equipment. Now that they've given you that concept, they're going to throw that in here. These get used probably more than any other ratios, especially for small businesses, which I do a lot of work for. And they measure something called liquidity, which is our ability to convert our assets to cash, and solvency, which is our ability to pay our debts. Okay. The first is working capital. It's the excess of current assets over current liabilities. So we'll calculate working capital as current assets minus current liabilities. Remember, current assets are assets that are either already cash, or we expect to convert to cash or to consume or use up within the next year. So really, it's like money available for use, as opposed to, you know, how if your grandma ever bought you savings bonds or something, you had money, but it wasn't actually money you were allowed to use because it wasn't mature yet. And so this is money that you're able to use in the next year. So working capital, current assets minus current liabilities. Current liabilities are those debts that are going to be due within the next year. So this measures our solvency. Are we going to have enough cash available to pay off our debts? Does that make sense? So working capital is just our current assets minus our current liabilities. If this number is negative, it means we don't have enough current assets to cover our current liabilities. We're going to have to generate some, right, through hopefully collecting money from people that owe us or selling more stuff to people and collecting cash. It's not a great place to be in as a business where you're dependent upon, you know, new business to pay your debts. It's sort of like it's not a great place to be in financially as an individual if you have debts that you're just hoping that you're, you know, that the minute you lose your job or something, you're in trouble because you don't have anything to cover, as opposed to having enough assets to sort of cover yourself for a period of time, so that if you lost your job or whatever, you would be able to, you know, still find something new. Working capital equals current assets minus current liabilities. So this company's working capital was 7745 minus 1390, 6355. Okay. The other current ratio is just current assets divided by current liabilities. So if our current assets equal our current liabilities, what would our current ratio be? 1. Good. So a current ratio of greater than 1 indicates what? No. It indicates we have more current assets than we have current liabilities. If it's less than 1, then we have more liabilities than we have assets. Okay. And so this is one used by loan officers all the time. And they usually like to see a current ratio of about 2.0 before they start to loan money. The poor business owner always says, if I had a current ratio of 2, I wouldn't need to borrow money because I would have double the amount of assets over my debts. but this is, this is the bank saying, we don't want to get you into trouble by loaning you more than you could afford to pay off. So we want to make sure you have a nice cushion. So current ratio, current assets divided by current liabilities. So these guys have 5.6. They could probably get a loan, although if this is their total assets, $7,000, they would be able to get a very big loan, right? Because we're not talking about tons of money here. All right. Well, this was just me. There's like an appendix in the book because I mentioned these spreadsheets, right? Or where so I just want to walk you through what one would look like before we had. So this has our assets, liabilities, stockholders' equity, rent, revenue, and expenses all summarized on the unadjusted trial balance columns. That would be the same as if you had a standalone document called unadjusted trial balance. Then we do our adjustment data and create the adjustments, just like we did in chapter 3. And then we can say, okay, so this has a debit balance of 2,065, no adjustment, so it's going to have a new debit balance of 2,065. This one has a debit balance of 2,220, a debit adjustment of 500. So what's going to be the new balance of this one?
2,700.
A debit of 2,720, right? Yeah. This one has a debit balance of 2,000 and a credit adjustment of 1,240. So it's going to have a new balance of
760.
Of a debit of 760, and so forth. So it's instead of doing a ledger or something, it just lets us do it right across the columns. So now we have an adjusted trial balance, all right there. We'll see that our debits and credits equal each other. So once we have an adjusted trial balance, we can figure out our income statement amounts. And that's going to be our revenues, our expenses, and then our balance sheets. Assets all have debit balances, liabilities have credit, dividends have the debit. Okay. And then there's these sort of empty boxes at the bottom. And so you'll see on this one, when we add up our credits and our debits, they don't balance. Why? Because there's a difference between our revenues and expenses, and that amount is our net income. So we enter that here, and then we can add, there's our expenses plus our net income, equal our revenue. But we can't just add something on the debit side without putting it on the credit side. So we put it over there. That represents the amount that's going to go to retained earnings as net income, right? And that actually adds up to the difference between all of our assets and liabilities with dividends figured in. So that's how you do this spreadsheet. A lot of times in the good old days, accountants would do this spreadsheet because then they're like, I have all the data I need to prepare the financial statements right there in one place.